Hello and welcome to Fund to Money. Here we will be discussing the tax implication or the income tax on residential property sale or sale of residential property. Basically, the tax you pay when you sell a residential property. And here it's worth pointing out we are not looking at other forms of what is known as property, with jewelry, even within real estate. There is agricultural sort of properties or land. So we are looking at immovable residential property or residential property, and we'll be talking basically about how they are taxed when you actually sell the property. You make capital gains. If the price is higher than what you bought at, and how it is taxed, that's what we're going to be looking at, and we'll be touching on the strategy, how you can save the tax. In the subsequent companion presentation, the second part, in another presentation which will accompany this, a separate presentation, we'll be talking specifically and in great detail on what you need to do to save tax or plan your tax. Here we'll be just broadly outlining some of the approaches. So that's what we plan to do here. We'll be coming back with the details in just a little while. Welcome back. Welcome to Fund to Money. We're discussing the impact of income tax on residential property sale proceeds. You make money and you sell real estate, and how is that money that you get on real estate, residential real estate or residential property, how is it taxed? Now this is very different from some of the other properties. For tax purposes, this is an immovable property. We're talking residential property. How is it taxed? Now basically we're talking about a residential property which is either let out or you're self-occupied, you're staying in it. So that's how it is. That's the area that we will be looking at. Now, depending on the tax treatment, actually depends on how long you hold it, whether it's 2 years, because if it's 2 years is the cutoff period. If it's less than 2 years, then what happens is it's termed as short-term capital gains. But the tax that you pay is basically on the gain that you make. It's not on the whole proceed. It's the gains that you make. So during that period, if you've held that property for that period, then what happens is it's termed as short-term capital gains. And if it's more than 2 years, there's you pay. It's seen as long-term capital gains. For short-term capital gains, it's short-term capital gains tax, which is basically your income tax rate. You pay at the slab. For long-term capital gains, you get inflation indexation benefits. So basically, the costs that you incur of acquiring it, improving it, they get deducted from your final sale proceeds. But you also enjoy inflation indexation benefits when you're doing a long-term. You have a long-term capital gains, which is something that you do not enjoy when you're making short-term capital gains. So in case of long-term capital gains, what's also happening is, because of the inflation indexation, your costs are getting enhanced. Your taxable capital gains becomes less. Apart from the enhancement of your costs, acquisition and improvement, you do some improvement. You can also deduct brokerage, transaction costs like brokerage. Now you're allowed to do that even in your short-term capital gains. That's how you get it. All the costs that you incur is deducted from the final sale proceeds, but there you don't get the inflation indexation benefit, and you're paying your income tax rate. Here you're paying a lower tax rate. So therefore, longer you hold the property, lesser you pay the tax, right? And the cutoff year being 2 years, before it used to be 3 years. So this is something that you need to keep in mind. Now, why is this so important? So basically, the tax implications are important because when you're actually selling a residential real estate, you're actually getting a pretty large amount, regardless of whatever be the size of the property, and therefore the tax outflow can be quite a bit. So you need to plan in advance as to whether you'll be paying the tax, whatever the tax is, and get the money and then do whatever you want to do with it, or you're going to the strategy is to save tax, because tax planning, the tax laws are such that it allows you to do certain things, take certain action, which make you eligible to get tax benefits or tax deductions. Now, to do that, to get tax savings, which we'll only very briefly touch in this presentation, in the accompanying presentation, in a companion presentation, we'll be discussing that. So you basically, there are two options. You again invest in a real estate which is sort of built, ready to move in kind of a real estate, so residential property. So you can do that, or a property which is under construction. So basically, you're investing in a residential real estate. Again, that's one route. The other route is capital gains tax saving bonds, which are issued by specific institutions like RSC, REC, NHAI, PFC. So you can save a tax till up to 50 lakhs. And here, of course, when you're doing real estate, up to 2 homes of value for capital gains not exceeding 2 crores, and you can do this once a lifetime. All right. So all this that's happening are things that you need to keep in mind. If you're doing a tax saving, then you need to plan reasonably in advance. So we'll be discussing all these things in some detail. Let's jump into the capital gains aspect a little bit more. In short-term capital gains, less than 2 years, the capital gains that you make, you need to pay tax. Now, basically, to calculate, it's pretty straightforward. You've made a gain. Rather, let's go with the proceeds. You suppose, for simplicity's sake, you've got 1,000 rupees as sales proceeds. Now you need to deduct your the various costs. So one would be the price that you paid. Suppose it was 500 rupees. You can deduct 500 from that, from your 1,000 rupees. Suppose you spend 100 rupees on eligible, the critical part is eligible sort of expenses for improvement, so that you can deduct. And suppose there were transaction costs like brokerage, you can deduct that. So if 100 was improvement, 50 was brokerage, 500 you paid for acquiring, 650, 350 is your capital gains, you pay tax, income tax. The short-term capital gains tax in this case is your income tax slab. So that's what you pay. In case of long-term capital gains tax, on long-term capital gains, which is more than 2 years, 2 years cut off and 2 years and more. So then what happens is, there you sort of suppose 1,000 rupees was your acquisition, rather your sales proceeds. You can, whatever you had acquired. So here you have you will be getting inflation indexation benefits. So suppose it was 500 rupees. The inflation went up during the period you held the property by 10%. So index was at 100. Just a very simple illustration. It's not exact, but the inflation index during that period you held the property moved from 100 to 110. That means roughly a 10% sort of a markup. If you're 500 rupees you had at which you bought up, so that is the markup. So 550. This is a very rough back of the envelope calculation. This is not exactly how you go about it, but it'll still give you an idea. Suppose you did the improvement at some point of time when that's when the index was 105, and when you sold it, it was 110. So the points in the index, that inflation index that moved, that will be taken into account in marking up your improvement cost, right? So you add that, and then if you've done any transaction cost brokerage, you add that, and obviously it will be a higher amount that you're deducting compared to a short-term capital gain from your sale proceeds. And on this sale proceeds, you pay from the sale capital gains that you get after you've deducted from 1000 rupees, whatever you get, that is what you need to, on that you pay 20% tax. So it will be far lesser in short than short-term capital gains tax, short-term tax that you paid on short-term capital gains. And this is what you need to keep looking at. Now, the tax that you need to pay is you're eligible to pay the tax in the year that you've sold the properties. That's why that planning is so very important. If you think that it's going to take you some time, you can actually put the money in a capital gains account, which is available in a PSU bank and some other banks. You put that money. So whenever you actually deploy it if you want to save tax. If you don't want to save tax, then you pay the tax and get the money and do whatever you want to do. But if you want to save tax, then you can actually put the money in a capital gains account, and then you can figure out what you want to do with whether you want to buy a property which is being under construction. If it's under construction, you're allowed to do it. You can buy it within 3 years of your sale of property. If you want to buy a ready-made property, you want to move in. Now the thing is that you could have bought the property 1 year before you sold the previous property, or within 2 years of selling the property. After 2 years of selling the property, that's the timeline within which you need to do it. You can actually you can exhaust the full capital gains in doing that. If you don't exhaust the full capital gains, that part is taxed. So suppose you made 2 lakhs or 10 lakhs or whatever, and you used up 90% of it. So if you made 10 lakhs and you've used up 9.5 lakhs, so the remaining part which is left, which you couldn't use, will get taxed. If you don't actually use up, you don't manage to invest within the period stipulated, then you actually end up getting paid tax. Remember when you actually buy a property, then you need to hold it for 3 years, otherwise you lose the tax exemptions that you get. So we'll be discussing them in greater detail. The other option, of course, as you mentioned, you need to you can buy capital gains tax saving bonds, but that is only, you can make an investment till only 50 lakhs, and there the money gets locked for 5 years. We'll be discussing these things in detail. Even in capital gains account, the money that you use up for investments in real estate, that is the part that you get exemption. Apart from that, you pay tax for it. So this is roughly the play, the expanse of this whole discussion. We hope you found this useful. Please do wait for our accompanying piece, where we'll be discussing tax savings on property sale proceeds in greater detail, and we'll be talking about this. And you can follow our other discussions, presentations. They're full of them. You check out our playlist, subscribe to our channel, get connected with us on all leading social media networks. Do wait for our next presentation. Till the next time, take very good care of yourself, and goodbye.